The yield on Spanish 10-year bonds crossed 7% as investors brace for a disappointment from Eurozone finance ministers who are meeting today. Second quarter earnings season will kick off this afternoon with Bellwether Alcoa reporting results after the close. I'm Lindsey Bell, and the morning call starts right now.
Good morning, I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Lindsey Bell with The Street, and together we bring you the morning call. On Friday, the market sold off after a weaker than expected jobs number. Then over the weekend, we got some bad numbers out of China, indicating possibly a harder landing there. And now Spanish 10-year yield is above 7%. This doesn't set up well going into earnings season for us.
Every piece of data seems to support the growth slowing thesis. So you had that tug of war in the past week and a half between the hopes and prayers of a stimulus, rate cuts, whatever, a hope. What's the word here that I'm trying to look for? Anyway, you can't have a sustained move based on the fact that you want rate cuts and stimulus when there's no growth or growth slowing. So we had a mechanical move going in from July 4th weekend into the new quarter. What that means is people wanted to mark up stocks, and they also had some new flows coming in for the new quarter. So what that did is that drove the market higher, it squeezed the shorts, and now we're coming into a time period when you're about a week and a half after reality sets in, and now the market has a lot to prove. So with the jobs number Friday, you saw a pull-in. You know, I think it was somewhat muted. You know, you had Tuesday, Wednesday of last week. We talked about the oscillator being plus 70, plus 80, a great sign to sell stocks. So you had opportunities to maneuver your portfolio into strength instead of having to make decisions whether or not you want to get upper level stopped out or sell into some weakness, as we could see a bit of that in the next few sessions.
So is this going to be another summer like last summer where this marked the peak of the year?
It could be, and people are saying that, and rightly so. We had the exact same setup where you had to squeeze through into Jobs Friday, and that was a summer top. So what we have to do is we have to measure the commitment, and the way we do that is you look at the chart of, just say, the spiders here. So far Friday, I think the market took it in stride, because if you look at the rally that we've had, you know, we held support here, we held this 130.80. This was a level that, you know, was support in early June, became again support in late June. You had that huge move. Here was the gap. That's where it started after the EU news, you know, the TARP of Europe, so to speak, whatever. And then Friday we came in and we held it. We talked about 134.85. I think we tweeted about it a few times. And look at this, 134.85. And what's this here? 134.85. Whoa, voodoo. Anyway, this is your new point of reference. This is your support. If we were to hold this support moving forward, I would think that it would be very constructive for the market. I think people would have to buy some stocks, unfortunately, or, you know, they'd be a little thrown off. And we could actually even come in a little bit more and still have this current uptrend or rally in check without calling a summer top.
But can we take a look at the Fibonacci retracement levels just to see if this gap doesn't hold, where can we go?
I think that's important because last time when the market started to falter, we held that 61.8% retracement. And right now we're at the 38.2. So if you go to the chart, I'll show you what I'm talking about here. You know, if you go to your Fibonacci retracements, which are right here, you know, last time we talked about them, this was the low, okay, that was put in late May. And then you go all the way to the high here. So if you remember, we came in and we measured. We broke the 25 to 38. What did we hold? The 61.8. So this is where we held, which was also support from earlier June. And then we resumed. So if we take this out of the way so you can see a clearer picture of, you know, doing it once again, because we always want to measure commitment to recent moves. And from here to where we just went, if you go to the low, all the way to the recent high of about 1375 or so, you know, we just came into the 38.2% retracement, which held. The 50% stands around 134.30. So if we trade into the gap, right down 134.20, 134.30, that's a spot that, you know, people will look at. And then really I would say the line in the sand, which is the same line in the sand, a very sturdy, spidey thread that held, you know, recently back here, comes in right around here. If we start breaking below 133.50-ish, I would say that most bullish guys out there will start to leave, and then we could hear the retest of this area and the retest of the low chance, which rightly so considering all the data that we've seen.
In the sector spotlight, we're going to talk about some tech stocks just because on Friday, they were the ones that led the market down, which was interesting because the Friday before they led the market up when the EU summit news came out. We're going to kick it off with Apple here. On Thursday, they were able to get above $600, and Friday they held above that level, though dipped back just a tad bit. What are you looking for in this one? Can this one stay above $600, or do you think we'll get a better buying opportunity given the macro pressures?
Well, we're going to watch out to see what kind of damage we have. And we saw on Friday, it pulled back, but it was pretty limited. You know, the stock had a 40-point move from that spirited rally from the EU on Friday. We had two different buy points. We had 584 as a buy point, 590 is a buy point on the price point sheet, and it went into resistance, and you know what, it sold down, big deal. You look at the chart here, you know, you will see that this was when it broke this little descending channel, and descending channels typically break to the upside like you saw right here. So one entry was right around 576. If you missed that, really when it traded above 584, I think you could have had your entry, or even when it cleared this resistance at 590. So if you look at what happened on Friday, all it really did, it retested this 600 area, or the century mark, so to speak, and came off those lows. So I would say today, you know, maybe we have another inside day. I would say if it builds a floor above 600, you know, you will see this stock showing leadership. You will see limited damage in other maybe leaders out there. And then when it clears this 615, I have a feeling it's going to take earnings to do so, or need earnings. You know, it can make new highs on this year. But for right now, short-term traders, watch this 600 area, maybe buy versus that. And if we do see really heavy pressure on the markets, I would love to be able to rebuy this thing at around 590, because that'll be a nice pull-in, about 50% of the recent move. And that's what you want to do with these type of things. You want to buy the dip and you want to stay with them.
Amazon, another tech stock that's done pretty well this year. They might actually be competing with Apple in the smartphone space soon. But looking at that stock, it's trading above all of its moving averages. Is there any reason that the intermediate uptrend can't continue here?
Well, I think at this point, it's been a very slow trade with Amazon, slower than normal, but rightly so. It's had a big move, and people are concerned of what's going to happen in this earnings cycle, this earnings season with Amazon. Last quarter, they finally came out after missing the prior two, and it was good, and it gapped up, and it was a great trade since then. If you go to the chart, you will see that, you know, the stock gapped up on earnings, and it gave you a few trades in there where it started to trade into the gap. So some guys made money short here. And then when it reversed on this day, that was your day to get long. And now it's been following another trend here. So, you know, this is actually an ascending channel. And unfortunately, ascending channels sometimes break to the downside. So you just want to watch out here. Short term, you know, trade versus 224. 224 is an area of support. If it breaks this, you know, next level underneath it is around, you know, 218 to 220. So if you're not committed to Amazon holding it through earnings, you know, and it starts to break this ascending channel, I think you get out of the way and just day trade it until we get closer to earnings. But overall, on a macro basis, you know, it is acting well, like you said. It's above all the moving averages. It's a stone throw away from the recent highs. So if they deliver, the stock will deliver. But you know, the expectations are high here.
Netflix, this stock popped 14% on Thursday after news came out that its streaming business reached 1 billion users in June, which is the highest ever for a single month. We don't know what the profitability looks like on that stock. This stock has been a little more controversial. So what are the levels you're watching in this?
Well, this is interesting because people say, how did you know it was going to be up and be the biggest winner? You know what? I didn't know. But if you looked at the chart, it was nice and tight. I tweeted out there, I said, you know what, Amazon has two buy points, or not Amazon, Netflix. One was 69.50, one was 70.50. Just to clear this lower level pivot with a big short interest, and it being Netflix, and it came off from 130 down here, was worth looking. So if you go to the chart, you know, this was the day that it broke above this little minor pivot. And anyone in Twitter, all of our subscribers, 70.50, Sperling was actually all over this. I made a little trade, he made a big trade. And this was the level it broke above, and then it had some follow through, nice follow through, and then, you know, a nice little red dog reversal type day. Some guys actually made money here, you know, as it traded higher and then recrossed this prior high here of 82.90, and then it closed okay. So I would say it needs a little bit of a break, but at least it's back in the game, so it gives us a vehicle to trade for cash flow. Here is support one now, this 80.22. I think there's another level right around here, 50% of that wide range bar around 70.70. The longer it stays above, you know, support one and support two, the higher the probability it can continue. And it also, if you look right here, it's still being contained by this huge pro gap to the downside. So right now this is just considered a reflex move. I would say day traders only, you know, very savvy investors only, because it is very tricky.
Facebook's had some great momentum. It was one of the only stocks up on Friday in the tech space, so it had some relative strength there. What are you thinking on this one?
This one it hasn't had like such big momentum yet, but it's been trading better. And we had a buy price last month when it did the red dog reversal, and then when it went above 28.10, and then the underwriters actually poured some cold water on it, which rightly so, because again it had a big move, so people wanted an excuse to sell it. So here is buy strategy number one. Actually, this was buy strategy number one, but it failed. Here is buy strategy number two that actually worked. Here was your ad. This was going into the underwriters coming out with, I think, realistic expectations. I'm happy that they didn't say 400, 1,000 or whatever the hell it was that people were saying they should have. Anyway, at this point, it held the moving averages. It's starting to come up. I would say in order for it to get momentum, which would be nice, if it could trade with some volume above 32-ish, then your next point of reference here is 33.44, and then it has room to go higher. If you're long it and you're uncommitted, use this 30.55 as a stop. This is one of my few longs, and I think that today they came out with some news, the Facebook jobs board, which could be a little bit of a concern for LinkedIn. I don't think so, but I do think people are looking for ways for them to make money and revenue, so maybe this will be a catalyst for the stock today.
Sure. It's another news piece out on that, as well as with YHOO. The YHOO and Facebook decided to reach a settlement on a patent lawsuit they had. So the YHOO stock was down, though, on Friday. So why don't we take a look at that one?
This stock's been in such a tight channel for such a long period of time. Obviously, they should have sold to Microsoft way back when. But anyway, if you look at this tight channel, something has to happen soon, right? If you look here going sideways, it's just done absolutely nothing. I don't even think it hasn't been on my trading plan, hasn't been on my go-to sheet, hasn't been on anything in a long time. But somebody in here is accumulating stock. It's changing hands between 14 and 16, so someone thinks something's going to happen here. So if you want to be in some, being a tier one, but in order for it to really get going as a trade, it's got to trade above this 16, and then maybe you get some intraday action. But right now, this has been going sideways for a long time, so something's going to give soon, and hopefully if you're long, it's to the upside, and for a trade above 16, your next point of reference here is about 16.75. And I guess let's just go to the weekly chart real quick, because it's been doing this for a long time. If you take this and this out of the way, really it's been going sideways for almost 2-3 years now. So someone is getting in here and accumulating it for what could be, they turned down 33, 34. Maybe the next deal they get could be 22 to 24. We'll see.
We will see. We're going to take a quick commercial break, though, and we'll get back into the trenches with some of the Dow leaders on Friday.
Hello, everybody. My name is Pete Renzulli, Chief Marketing Officer of T3Live.com and one of the traders in the active mentor room for T3 Trading Group. What I'd like to do today is I'm really excited about introducing you to and inviting you to the first T3 Live Active Trader Summit in New York City, which is on Saturday, July 14th. We're going to have quite a few speakers today. There's going to be myself, Mike Lee, Evan Lazarus, Mark Sperling, Rob Smith, Rick Meadows. There's going to be a ton of great content, but the number one reason you want to come is you want to be able to network and associate with other like-minded people like myself. I'm going to pump you up. I'm going to guarantee you that. Other people like yourself who have a burning desire to learn how to be a trader. So I'm going to ask you to make a trade. Trade one Saturday for some of your time to come down and learn strategies, tactics, techniques, and put some faces to the people that you see in the virtual trading floor in T3 Live, and learn to take your trading bigger. Learn how to be a better trader than you are now. Learn the strategies. It's going to be a lot of fun. I can't stress that. I know it's a Saturday, but you know what? I want you to be there, to get excited, and to be here. Prove to yourself how bad you want it. Show up and come down and get excited with us. Saturday, July 14th. Now, very quickly for the registration. All you have to do is register at T3Live.com or be an existing member of T3Live.com, and you get 2 complimentary admission tickets for free. So all you have to do is go to T3Live.com and register. If you would like to join us at the post-event cocktail reception, you can also upgrade to either premium or VIP. That's up to you, but either way, please take advantage of the general admission, 2 free tickets. Bring a friend, bring a neighbor, bring a wife, bring a girlfriend, maybe bring both, but come down and expect to have a great time. Saturday, July 14th, here in New York City.
Welcome back. We're going to dig into some Dow leaders on Friday. We'll start with AT&T. This stock actually had a couple moves down before a little flat episode on Friday.
Well, it had a nice run, so profit takers always look for excuses, and this one's been, traveling a nice course. So if you look here at the chart, you will see that, it came into a decent level of support, so that's what held for now. You're seeing still a lot of breakout failures in this market, and it tried to break out right around here, tried to clear this 36, and it couldn't. So a lot of these have led to bigger moves lower. So I'm not saying there's a bigger move lower in store here, but I would say if you're uncommitted to this stock, let it trade versus 34.90. If it breaks 34.90 and then just say, this some last ascending channel or this rising uptrend breaks, you could easily see a move down to 34.26. So not too far down, but if you're not in the stock, I think you could wait. I think you get 34.26. And if you're uncommitted to it, if it breaks this, I think maybe being flexible and seeing if this holds is a better situation for you.
McDonald's, Stephanie Link at Action Alerts Plus actually owns this one, and she'll look to add to it on pullbacks in the stock. She likes the consistent growth. There's a dividend there, and the year-to-date underperformance versus its peers. So she thinks that this one has a little more room to grow.
I think if you sold it correctly, because it showed a very faulty pattern months ago, you could buy the dip, and why not? In a lot of these macro mega caps, you have to buy the dip because it's so far and few between that you get momentum. And there's actually a tradable pattern, I think, here for traders not involved. There's this lower pivot, there's a small downtrend. We've seen a lot of these type of scenarios break it to the upside for cash flow. So if you look here at McDonald's, you will see. Here's where it broke macro support. So if you sold, around 95, 96, you saved yourself some pain. And now, you have this downtrend right here. You have this lower pivot. It's almost like a bit of an angle of an inverted head and shoulders pattern where here's your left shoulder, here's your head, here's your right shoulder. You have a neckline right there. Let me give you a closer look. So I would say if this were, to start trading above right here, okay, this level right there, I think traders are going to start to get involved for momentum. So I would say above 90, and you could have a quick move if the market stays firm, and you can see 92.20, which will be some resistance, and then there's going to be heavy resistance up here. But for a macro investor looking to get in, if they sold into this mess, be in a tier 1 as a trader, see if it could finally break this little lower pivot for a cash flow trade back to about 92.29.
Walmart's a stock that's been really pretty good this year. It's a defensive play, and it's been showing strength despite the macro pressures we've seen. Cost-conscious retailers or consumers have been going there. It's always been crowded, and people are always like, what was wrong with Walmart? The fact of the matter is it was one of the best stocks in the 90s, and stocks need to consolidate, need to get new investors, they need to get institutions to exchange hands. And the reason why this was my stock of the year or my retail stock of the year is because it was in a decade base, and I said if it breaks above a certain level, you're gonna have a nice move because of the commitment to it. So if you look here at the chart of Walmart, you will see that level was right around 62. My target was 72 to 74. It's now at 71.38. It looks good. It just cleared another area, so it's showing consistent movement. Each time it stopped, it's paused and giving you a nice new entry. At this point, I wouldn't enter Walmart or initiate a new position. I would sell into strength, but then also keep some, because if you go back to the monthly chart, you will see it's just starting to break above a lot of these key levels. So, it can continue. And like I said before, look at this move that Walmart had earlier in a decade, and it needs to consolidate, and it's been going sideways for a decade here. That's a lot of new people in there. It's just clearing it, so don't fight this one and try and stay with a little bit. Verizon, it's up about 11% year to date. It's been another strong stock. They have earnings coming out next week, and if we get a good earnings report there, it's a possibility that we could see more upside.
I think a lot of people have been going into Verizon for the dividend, and you've also got the dividend, and now you had some stock appreciation. So at this point, it's had a nice move. It corrected a bit, and really not much. Kind of looks like AT&T, so rightly so. You had the gap down with the rest of the market, and it didn't even get to support like that AT&T did, so it held in there. I still think this is above the moving averages. You have nothing really to fear here. It's always good to sell some along the way. This was a nice little trade for guys looking at a tight pattern. Then it broke out again. And at this point, I would say if you're not committed, just like we have higher, you have low-level stops, you have high-level stops. This 43.65 I think is pretty big support. If that were to break, the 50-day moving average is all the way down here. So, at this point, big move. I always say you could sell some along the way, trade some, trail some at this point. Don't chase some.
Getting into some quick hits, let's start with Nike. That stock took a big hit when they reported earnings that were pretty bad not too long ago. But Stephanie Link was buying this on Friday. She kind of thinks that the bad news is already priced into the stock since it has had that big move down.
Yeah, well, if you didn't own it before, you know, sometimes bad news is good because the bad news finally gets all the weak share or weak hands out of it. And you saw a big gap down in Nike that was somewhat bought. So if you go to the chart, you always want to see if a stock could come well off the lows after, you know, a big shock, so to speak. You know, it means it could have been done or over with. Here was your exit point in Nike. You know, first we talk about breakout failures. This had one. This was your red flag that maybe something's wrong here. And then, you know, you had a high, lower high, lower high. Then, you know, this wide range bar broke below this pivot and that pivot, and that was really your exit. So if you did exit there, you have the opportunity of buying back here. It's trying to make its way into the gap. You know, so look here, there are some trades. If it goes sideways and continues, maybe my guys will be looking for a trade above 92.70 for more of a gap fill. But I will say, just by being a triathlete and being out there and being in all the stores, I don't see any runners. I don't see Nike anywhere anymore. Okay, maybe
Really?
they're in basketball or whatnot, but I see Brooks, I see Asics, I see all these other sneakers. I don't see anyone buying Nikes. I used to buy Nikes all the time, and I haven't bought one in 5 years. So sometimes the Warren Buffett way makes sense. We're like, okay, if you don't see it, you don't like it. Maybe other people don't see it, don't like it, but you know, it's just something off the cuff.
Under Armour, just continuing with the sporting trend, it's a breakout failure that we've also talked about more recently.
Yeah, and Under Armour, when it first came public, I'm like, oh, I like this stuff. You know, it keeps me warm. I train outside, and you know, it made me inclined to keep it on the go-to list. And then technically, it acted really well. But that was over the course of the past 5 years. And now, you know, it's coming. It had some technical damage. If you look here, we talked about the breakout failure in Under Armour, which was right around here. Okay, this is when you had a small little red dog reversal followed by a down day. This was, you know, it tried to break out above it, and then I think it was downgraded this day, and it couldn't see a friend, couldn't bounce off the low, so that was your day to get out if you were uncommitted. And now it's really, it's I would say technically showing more weaker signs than stronger signs. It's not really taking back much of this down move right here from the highs to here, so somewhat of a bear flag. If it doesn't get above this 95.5, continues to go sideways, this is prone to break this big 90 area, so I'd be a little cautious here with Under Armour.
Well, those are just a couple of our quick hits, but we're running out of time, so be sure to check in at the end of the day with Scott and the T3 Live team for the daily recap.